Green bond scrutiny is tightening capital access for some. The Green, Social, Sustainability, and Sustainability Linked GSSS bond market crossed $1 trillion in global issuance for the first time in 2024, according to IFC and Amundi's annual Emerging Market Green Bonds report. Green bonds alone accounted for $577 billion. The capital is real, durable, and growing. But the headline obscures a more complicated picture. The market is expanding in volume while tightening in access. And for executives making capital structure decisions, understanding which side of that divide their organization sits on is increasingly consequential. The greenium is fading. For most of the green bond market's history, issuers could expect a modest pricing advantage. The greenium, the yield discount relative to comparable conventional bonds, reflecting scarcity and the willingness of sustainability-mandated investors to accept slightly lower returns. That advantage is nearly gone. According to Amundi's calculations, the greenium more than halved to 1.2 basis points in 2024, down from 2.5 basis points the prior year. In emerging markets, it effectively disappeared as supply caught up with investor demand. Research from the Nordic ESG Lab, drawing on nearly 50,000 bonds issued between 2015 and 2025 across Europe, North America, and China, identified three structural causes. Supply has overtaken scarcity, improved disclosure standards have reduced the information asymmetry that once justified a premium, and macroeconomic conditions have compressed risk premia broadly. The research also found a pattern with direct implications for carbon-intensive industries. High-emitting sectors, oil and gas, metals, and chemicals, have never achieved a material greenium. Investors appear unwilling to price a green label above their assessment of underlying carbon risk. For any organization in a high-emissions sector, considering green bonds as a cost of capital strategy, that reframes the calculus entirely. A new regulatory floor in Europe. The EU's European Green Bond Standard, EUGB, established under Regulation EU 2023-2631, became directly applicable across all EU member states on December 21, 2024, creating the first binding legal framework for bonds using the European Green Bond designation. The requirements are substantive. Issuers must allocate 100% of proceeds to EU taxonomy-aligned activities before maturity, publish a pre-issuance fact sheet reviewed by an ESMA-supervised external reviewer, file annual allocation reports until proceeds are fully deployed, and produce at least one environmental impact report over the bond's lifetime. The standard is technically voluntary. Issuers can still operate under EMA Green Bond Principles or the Climate Bond Standard. But the market signal is clear. The UGB sets a credibility benchmark that European institutional investors will increasingly use to evaluate competing issuances. Issuers who cannot meet UGB criteria are marketing against a standard they don't meet, in a market where scrutiny is rising. Sustainability-linked bonds, a separate problem. Sustainability-linked bonds, which tie coupon payments to the issuer meeting environmental targets rather than ring-fencing proceeds, are facing their own reckoning. Moody's forecast only $35 billion in sustainability-linked bond issuance for 2025, well below 2021 to 2023 records, citing persistent investor concern about target ambition and financial materiality. The structure's modest financial penalties for missed targets are increasingly viewed as insufficient assurance of real commitment. For issuers who have used sustainability-linked bonds as a lower compliance alternative to green bonds, the market's deteriorating appetite is a direct financing risk. The U.S. is moving in the opposite direction. While European regulatory infrastructure tightens, the U.S. market is diverging. AXA investment managers found an increase in U.S.-based issuers dropping the green label entirely in 2024, preferring conventional debt instruments without the disclosure obligations that come with labeled issuance. U.S. issuers are not abandoning sustainable investment. They are avoiding the label. For multinationals with capital needs in both markets, the practical implication is a bifurcated financing strategy. EU-aligned issuances requiring taxonomy documentation and independent review, while the same project financed in the U.S. could avoid that compliance infrastructure entirely. What this means for capital strategy. Moody's forecasts approximately $900 billion in green bond issuance for 2026. Sustainable funds hold $3.92 trillion in assets under management. Roughly $330 billion in existing GSSS bonds will need refinancing over the next 3 years. Investor demand is not going away, but access to that demand is differentiating. CFOs and Treasury teams face 3 direct questions. Does your organization have the disclosure infrastructure to support an UGB-compliant issuance? Are your sustainability targets specific and financially material enough to survive investor scrutiny? And does your emissions profile support a green label that investors will actually price above conventional debt? The green bond market once rewarded early movers with low disclosure burdens and a real cost advantage. That window has narrowed. The market now prices the difference between issuers who can deliver and those who cannot. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.